What's going on YouTube? It's your man Brian Rigbu, six-figure earner through part-time real estate investing, and welcome to video 3 out of 3 on how to start making money in real estate. This is the video where I'm going to show y'all a subject to transaction, and by the end of this video you're going to know how to buy a rental property with no cash and no credit. This is going to blow your mind. I mean, in all the years I've been on YouTube and been in this business, I've seen videos on fixing and flipping. I've seen videos on wholesaling. I've seen videos on owning rental properties, but I've never seen videos on how to complete a transaction like this. It's usually packaged up and sold, but I got y'all. I'm about to let the cat out the bag. So this is going to blow y'all mind. Y'all try to follow along with me and let's get to it. So first, let's get this clear. This is not an assumption. That's what a subject to is not. It's not an assumption. Many people may get a subject to and an assumption confused. An assumption, which is not what we're interested in, they're holding the mortgage and you're going to get approved, the normal approval process. So they're going to run your credit. You need to have all of the criteria needed for that buyer to be able to assume the loan. And after closing, basically, you'll own the property, but you'll also own the debt or the mortgage. The mortgage will be on in your name as well. So we don't want to do that. We're going to do a subject to. So what's the subject to? I'm glad you asked. A subject to is going to be when you take ownership of the property subject to the existing liens or loans. It was when someone is going to deed the property over to you, so now you're the owner of record. It is your house. You can do whatever you want with it. You can rent it, you can sell it, own or finance it, rent to buy it to someone else, whatever you want. But the debt does not go in your name. You now own the real estate, but the debt stays in the existing seller's name. Wow, you can't do that, right? So for anyone that tells you you can't do that, because most people are familiar with assumptions, but not subject tos, refer to a HUD document. So anytime in this country you purchase a piece of real estate and you go through a title company, you're gonna get what's called a HUD-1 settlement form, all right? It's kind of like a long document like this that has all of the, everything as far as closing costs and all of the fees and everything in closing. If you look at line number, I'm going to put it up on the screen, line number 503 and 203, there's two sides of it. It's going to talk about existing loans taken subject to, okay? And this means that if there's a previous loan on the property, you left that in place and you now became the owner. All right. Normally that doesn't take place. Normally there's a new loan originated in the closing process, and that's why the bank wants you to put 3.5% down or 5% down conventional or 20% down non-owner occupied. But with this, if you don't have to fill this out, the title company knows exactly how to do this, and a seasoned title company that is, and the escrow officers will take care of this HUD statement for you. Why is this so powerful? It's so powerful because literally you can own the real estate but not the debt. It doesn't affect your credit, your debt to income ratio. Let's break down how this actually works. And before we can really understand how it works, there's a few terms that I kind of want to go through. You guys probably are familiar with these terms, but I just want to review them really quick. First of all, there's one document called a deed. This is going to be a formal document that's going to be recorded at the county courthouse where you reside. All right, and this is basically going to be an instrument used to show who is the owner of the property or who has title, has ownership authority to do whatever with that property. Okay, now typically the person on the deed is usually the same person on the debt or the mortgage. And the mortgage, the balance that was agreed to be paid for the loan amount you need to pay for, and you're on the hook for to pay every single month until it's paid off. Well, traditionally, those names on those two documents are usually the same. But in this instance, what's going to happen is the mortgage is going to stay in place, but now you are going to become the owner. So let's say Jane Doe was originally the owner of this property and her name was on the deed. Also, Jane Doe has a debt on this property, so her name is also on the mortgage. Now, with a subject to transaction, Joe investor now becomes the owner of this property, and the balance of which you purchased the house for, well, the mortgage is going to be listed in the line existing loans taken subject to. So how do you do this with no money? Well, technically you can do it the same way you do a wholesale deal, which is after you get the property under contract, before closing, you can find a rent-to-own tenant buyer that's willing to put anywhere from 5%, or 3% down. So instead of like a regular rental where it's going to be $300 or $500, like a rent house or an apartment complex, they're going to put like $3,000 to $5,000 down. All right, and this can be what you use to cover your closing costs. And there's ways you can structure it so it really makes sense, and you do it legal. There's a few fine details, but that's how you're really going to structure it. And so at closing, you have a tenant lined up for the property, and you also have the money for closing costs, and you purchased it with no money down. Step 1, connect with the motivated seller. This can be you reaching out to a motivated seller, or a seller reaching out to you that's motivated and really need to sell their property. Okay, sounds familiar, right? In real estate, it all starts with a lead. Step 2, I usually like to always present a fast cash offer for like a wholesale deal first. But what if cash is not a fit? Sometimes they may say, oh, I can't tell that. I won't sell for that much. I'll let it burn down before I take that. Or there's no way, I would love to sell it for that much and get it done with, but we owe more than that. We can't do that. This is ideal for a subject to transaction. So if the seller is unwilling to take your low cash offer for whatever reason, offer to take over payments. All right, so that's step 2. If a fast cash offer is not a fit, offer to take over the payments. So number 3, this is what you're gonna do. Just because someone is willing to let you take over their payments and take over their house, it doesn't mean you should, okay? You can get yourself in a really stressful situation. So if the seller is even interested in what you have to offer, what you're gonna wanna do is you're gonna wanna really verify these loan details. All right, so you want to check a few things. Maybe see if the rate is adjustable or fixed, because you don't want to take over adjustable rate mortgage. I mean, let's say the payments are $900 this month. In 6 months, it can adjust to $1,300 a month and wipe out all of your cash flow. So that's one thing you want to do. You want to make sure it's a fixed rate mortgage. You want to see the balance on the property and the payoff, because you don't want to take over on a property that's upside down. You would much rather do a short sale on something like that, but that's for another video. So you want to make sure that the property is not upside down. All right, we talked about not having it an adjustable rate mortgage. And the most important thing, you want to make sure the PITI, or the PITI, that's the payments, the interest, the taxes, and the insurance. All of this, these payments that they use to pay make the payments every month to keep up the house, is less than what you know the property will rent for. If you know the property will rent for a lot more than they're paying to keep the property, this is a perfect subject to transaction or deal. All right, so that's the 3rd step. Just verify those few payment details. You can ask them, you can get their records. I would much rather them get on the phone and let you talk with their lender, so you can verify these details. So because you need to know all these details if you're going to become the owner of the property, right? Step 4, this is the good part. You're going to get this baby under contract. All right, so you guys going to get it under contract, and how you're purchasing it, instead of saying cash, is going to have that amount taken over subject to. All right, you get it under contract. All right, that's step 4, and you're going to get that over to the title company, and while they're doing their title search, you're going to start to market for rent-to-own buyers. So any type of fees for closing, and there's ways to do it outside of closing where you only have to pay a couple $100, but you want to make sure you got a clear title. But while they're doing a title search in step 4, and you've got it under contract, the title company's working on the title commitment, what you want to do is market for rent-to-own buyers, so you can find someone that really wants that house and wants to rent it for what you're marketing for. Okay, so once you take possession, you have a tenant, you have down payment. All right, so step 5. What's step 5? Step 5, you really just want to let the title company know that this is going to be a subject to transaction. You're not going through the lender for an assumption. You're simply getting the property deeded over to you, and that's it. You're now the owner of a new piece of real estate. I wish it was more complicated, but you know, it's really not. There are some nuances and some little fine details, but I'm sure you really kind of got the picture of it and the flow and the 5 steps through this short tutorial video. So of course, what are the risks involved? You mean to tell me I hear all this good stuff and there's no risk? Yeah, you're right. There's a few risks. So here's the risk. There's a few things you need to look out for. Of course, one is vacancy. You own a property that has a mortgage. So what happens when the property is vacant? You need to make sure you have reserves in the event of vacancy, so you can continue to keep those mortgage payments on time. And that's the reason why you normally, instead of just doing a regular rental, you do something like a rent to own, where you have a few thousand in the event of vacancies. All right, so that's one thing. Number 2 is, of course, we call it a due on sale clause. This is the lender. All right, this frightens people, but seasoned investors know that this is very rare. It's almost like winning the lottery if this happens to you. And the only reason something like this would happen is if you gave the lender a reason to. It's called the due on sale clause. This is when the lender automatically calls the note due because the deed transferred ownership. Be honest with you, the lender is only in one business, and that's lending money. They don't want houses back, okay? They want to lend money out and get interest off of money. So banks are not in the house business, so as long as you keep these mortgage payments paid, you'll be okay. There's nothing to really just kind of bug out on. Another thing though is insurance. You want to make sure your insurance is intact, because technically when a property transfers ownership on the deed, the previous insurance is null and void. So you want to make sure that your property is protected and you have an updated insurance policy in place. Because you see what happened to a lot of people during this Harvey situation, my mother included, that didn't have the type of insurance that was needed for that type of disaster. So those are the 3 main risks: a due on sale clause, vacancies, because vacancy, if you're not paying, can lead to a foreclosure and so on, and insurance, vacancy, due on sale. So those are a few things you want to watch out for. That's no reason to kind of shy away from this tactic, because the pros clearly outweigh the cons, and the cons can be mitigated. So you guys can use these no money down strategies, or you can choose to do it traditional, whatever works for you. But thank you guys for watching. If you like this video, like it, subscribe it, mash the like button, share it with your friends. Video is going to keep coming. Just give me some love in the comments. Let me know what you think. Let me know if you have any questions. Let me know what type of videos y'all want to hear more about. And see you guys in the next video.